I would agree with you actually on that. I don't think the market's surprised at all. I mean, down here in the coal mines, I would say that most conversations around, why are actually markets, doing so well? Why is risk appetite so strong, or why is not risk aversion stronger? Especially when every other day you're going to get some hawkish commentary. So I do think that we should look at the demand outlook up ahead, but markets should not be surprised if any central bank around the world will continue to try to push the limits of how much tightening that they could do. So it's all going to be a shaky environment up ahead.
But I mean, the fact of the matter is that the Fed may be being relatively hawkish compared to where it's been. But the current Fed policies, if we extrapolate the SEP, the Summary of Economic Projections, to the end of next year, forget about this year, we're still not particularly hawkish. In fact, I would say it's still very, very benign cost of finance, isn't it?
I would agree with that as well. So, when will markets actually acknowledge, okay, things are going to be much more hawkish on a structural level? What will them actually start to factor in, let's say, a stronger discount factor, for equity earnings and other issues? If we start to see a shift in terms of where terminal rates are, where equilibrium rates are, that is, I would say, a conversation maybe the Fed is not willing to have yet. Most central bankers are not willing to have yet. But if we actually do move towards restrictive policy, then that is going to be a different story. But now, I guess there's still this relatively lazy view that no, the Fed's not going to really take a hammer to risk appetite and risk growth, et cetera, et cetera. They're still going to be very, very cautious, even though the commentary is a bit different. So maybe a combination of wishful thinking, versus some of the data wobbles that we've had, but the jury's still out.
Well, that's fascinating. So you describe it as wishful thinking here, Jeffrey. We all know it's pretty hard to leave a fun cocktail party when the bowl's just been refilled and you think there's an opportunity for a very pleasant evening. But the Fed governors are telling you, aren't they, that rates are going up, monetary conditions are going to tighten, and liquidity is going to slowly drain away from these markets. What advice are you giving your clients about how they position?
Well, at this point, looking at our underlying custody flow data, especially in the developed markets, the only market over the past week that we saw net inflows was actually New Zealand, a smaller market, whereas some of the larger ones, the strong ones, all saw outflows, and they've been accelerating. So maybe on the face of it, price action or the levels that we see on our screens suggest that risk appetite is holding up well, but the underlying flows we're seeing within our custody side of things, that's actually a lot weaker, and it's been accelerating. The selling, to be clear, has been accelerating throughout the last month or so. Hence, we're actually a bit cautious in saying markets are actually still holding on to risk. And at this point, I do think clients just need to be wary. The view that central banks will not be willing to risk a recession to bring down inflation, that I think is one side of the wishful thinking that I mentioned earlier. The BOE initially did seem willing to bring down growth sharply to tame inflation. I don't see the Fed wouldn't do that, even though they do have a dual mandate as well. So I guess the only side of it, which is where some caution is more justified, is if some of the more forward-looking indicators, especially on the demand side, they actually do start to decelerate sharply within the next quarter, then maybe some central banks will adjust. We've seen that with the BOE already, but the UK is a bit of a unique case right now.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.